Basically, we'll be on track to be the first group of 100 students to lose their job upon graduation. And at that time, I was getting married, so it was an interesting time to tell my parents-in-law that, hey, your son-in-law is gonna be out of job very soon. When it comes to, let's say, a customer acquisition or so, for every 10 customers that I meet, give me a document I approve 2, meaning that I waste 8 of them or so, and that I need to reacquire them as customers, right? What if I can actually acquire them and keep them for longer? We managed to 6 times the GTV in 3 years, despite not knowing that much about payments. And one of the major lessons is that org structure is the last thing you should be integrating. What you should be integrating is mindset, thinking, culture, values, all the things that are below the surface. We're very fortunate that the core group stayed with us and integrate with Funding Society's team very well, and now it's become an integral part of our business. We were among the first to conduct a layoff, which was quite unheard of in the industry, right? Because to us, is that the writing was on the wall that this has to happen. It was a very painful moment because despite, in our view, doing the right thing, and turns out that all the team members did get great jobs from Grab and Amazon and Facebook and blah, blah, and so forth, but we were destroyed in social media, in news and whatnot, as if we are the only company that screwed up.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Hey Kelvin, really excited to have you on the show. You built a regional FinTech company, and I think it's so inspiring to so many people in the ecosystem. Kelvin, could you introduce yourself?
So maybe a quick introduction. I'm Kelvin, a co-founder of Funding Societies. We are the largest SME digital financing platform in Southeast Asia. We exist to really empower the growth of small and medium businesses, and we do it in 2 ways. Number one is by solving one of the biggest problems they have, which is really working capital loans. So really providing all forms of short-term working capital loans to small and medium businesses. And in 2022 December, we embark on a journey to solve the second big problem, which is really managing the payments in and out. And hence, we acquired CardUp with the MES approval, and now we offer both solutions, and we're operating across 5 countries in Southeast Asia, Singapore, Indonesia, Malaysia, Thailand, and Vietnam, having given out about 5 billion USD of financing to date, processing about 1.5 billion of payments every year, really empowering the growth of small and medium businesses. Hence, we call ourselves Funding Societies, fund the growth of societies. I think as an individual, I'm Malaysian by birth, came over to Singapore on an ASEAN scholarship, River Valley High School, A-levels at Victoria Junior College, and then National University of Singapore, where I graduated as a valedictorian in business administration accountancy. As the pioneer batch in accounting, went to the entrepreneurship program, NOC, to the US. That's also where I get first exposure towards entrepreneurship at the University of Pennsylvania. Came back, started my career with Accenture for management consulting, went to McKinsey after. That's where I did a bank transformation in Indonesia, KKR, for a brief period of private equity, but really more on the execution side. And then Harvard Business School, and that's where we started Funding Societies.
Yeah, fantastic. And we overlapped at Harvard Business School for
Yes.
MBA. And what I remember about you was I came in as a first-year student, and obviously you know all the other Southeast Asians. And I remember seeing you and your co-founder busy discussing what would become funding societies in the cafeteria, and really inspiring to see you working on a startup idea. And I mean, eventually I followed your tracks to also build a startup, more on the US base, but one of my memories of you building a company at HBS.
Like, time really flies. I think I still recall it wasn't an intentional idea of starting a company at Harvard. Like, I think most people would probably have chosen like the University at West Coast if you're looking to really like start a company to go to school for, right? But I think it was really serendipitous that we bumped into an idea that we're very passionate about, bound to each other, that I think together we have the path to be number one, even though we only have a PowerPoint deck at that point in time, and our values align very well. So my co-founder is Reynold, Wijaya. My classmate at Harvard Business School come from a family business background in Indonesia, and because our values aligned, passionate about big problem to solve, and there's a path to be number one, that's where we started. Even though at the time at the cafeteria, it probably didn't look like it. It was really just a few pieces of paper and 2 naive gentlemen.
Yeah, so let's talk about that moment, right? Because you went to HBS. Why did you go to HBS? Were you like saying to yourself, as an example, like I want to do more private equity. And for example, there's one path you could do after KKR, you go into consulting. Why did you choose a business school at that point of time?
So first and foremost, I think when it's a so-called the regular path for management consultants, that after 2 years of business analystship, the firm generally sponsors you for MBA. But I think it was a major decision because I think a lot of people go into MBA to get into private equity. And I was really in a very fortunate position to be part of the KKR capstone team at that point in time, and I didn't really want to move from capstone to the deal team per se, right? So actually I was already in a place that I actually enjoy very much. But I think I figured that life is probably more than just career, and I have only spent a year in the US prior, so I thought this is a good opportunity to just experience, expose, and then I think Harvard is a great opportunity at that point in time. Kennedy is also the only offer I got, so all the other universities rejected me. So
Hey, everyone rejected me except for Harvard. I think that's a good spot. They knew that you're too good for them. That's why, especially for the university on the West Coast.
I was also rejected by universities at the East Coast, so that was the but I was very fortunate, and because it's also a dream school when I grew up, so I thought, okay, that it's worthwhile. If it means that I can't go back to private equity, so be it. Also, and very fortunate things work out. Yeah.
Yeah. And so you went to HBS, and obviously you're willing to explore, learn. I think it's a good, some way, sabbatical or moment to do some reflection. And how do you even come to the point to be like, okay, I want to, for example, build a company, let alone FinTech, let alone, Southeast Asia, right? So those are like, and let alone your co-founder, right? So I mean, just saying, how did that happen? Yeah.
I think the starting point was that I think growing up, because I think both my co-founder came from a more humble background. So the goal for us is always to see how can we make Southeast Asia a better place, right? And that's why I entered the consulting, right? That, hey, if I can help companies to operate better and people spend so much part of their life working, like I can make the Southeast Asia a better place. So that was the genesis of it also. But I think the trigger at Harvard Business School was that when Peter Thiel came to school to give a speech, right? And at the time, he just published the book 0 to 1. Of course, trying to sell the book as well. But it was very inspiring. And one thing that he said, which shook me a bit, was that he mentioned that Asia doesn't need innovation. Asia just needs execution because it's so far behind, which is annoying but factually accurate in 2014, right? When that's the time when you have the Uber of Southeast Asia, the PayPal, whatever, also and so forth, Southeast Asia, right? So there was a lot of room to catch up. So that's why, following with the whole motivation of trying to do something for Southeast Asia and pay back, we thought, okay, let's see what can we do for the region. And following the same line of thought that given that Southeast Asia is behind in terms of innovation, let's look at what are the most innovative companies in US in the last 5 to 10 years. So first criteria was what we're passionate about. Second criteria was what we have a path to be number one. So we have seen very good biotech companies, but obviously we're not well suited to be number one in that phrase, that area. And number three is whether it can be a big and impactful company in the region or so. So we actually shortlisted, looking at the last 5 years of innovative companies in US, we actually shortlisted 2, right? One is basically Lending Cloud or Prosper, basically the P2P industry, which was at a peak at a point in time. And the second one was actually a TransferWise equivalent of Southeast Asia. But we figured that, hey, for remittance, you need to be on both legs. I will not win. So at least, we not with Reynold and myself. And if I look at when it comes to peer-to-peer lending, we can't quite copy the original model with just consumer lending, because at that point in time, we figured that the key success factor is going to be distribution, it's going to be technology. The Chinese will have the strength in technology, the big tech companies will have the strength in distribution. And even though at that point in time, there were not many players coming down yet, but the writing was on the wall that at some point by proximity, they are going to come, right? So, and it also doesn't match with the whole passion of making an impact in Southeast Asia as much, because not that they have no impact per se, but I think productive loans has more in terms of multiplier effect. So we thought we use that as a starting base and modify it for Southeast Asia. And we took the opportunity that Harvard gave to visit all the various P2P at that point in time, Funding Circle, Earners, I think we did not go to Lending Cloud, but we went to Prosper and so forth to really learn about how the business is being run and what are the intricacies of the business model and so forth, right? And because we're students, we were very open to share. So we decided to just put together some money between Reynold and myself. We did what is now known as a distributed team. We didn't know that existed of that concept at that point in time. We simply hired people using Skype. We put up job advertisements on startupjobsasia.com, interviewed using Skype, and we paid the team using internet banking. And we learned at like McKinsey for due diligence, right, that we check in at 9 p.m. Boston time, 9 a.m. Singapore time with the team, that this is what we're going to do for the day. We check out at 3 a.m. or 3 p.m. Singapore time, like, hey, what have you achieved, and then we repeat the whole cycle or so, right? And we thought it was possible because we saw that there was another startup in Indonesia that started by also by a McKinsey person from Stanford. And hey, if you can do it remote control, so can we, right? But little did we know of two things. One was that he had a founder in Indonesia. So if I'd known that he had a founder in Indonesia, like physically in Indonesia, I may not have withheld this belief and run it this way, right? But fortunately, I didn't know. And the second point was that there was a time we started in Singapore because it's the only country that we could set up, incorporate, while not being around. We were super excited, hey, the company is incorporated, because it took some time given that financial society is a gazetted word, but it reflected our vision. That's why we were insisting on it. When we told the team that, hey, the company is incorporated, like years later, the team members were telling me that, do you know that day when you told us that your company is incorporated, we were all shocked. I said, why? Like, it's a good news, right? We were so excited to share with you all. I said, we didn't know that we were working in a company that didn't exist for months. Like, we signed an employment contract with a company that did not exist. I was like, oh yes, that's a good point. So, we did pay your salaries anyway. So that's how young and naive we were, despite having a privilege of having very, very good education. Experience.
Amazing. And I think what's interesting is that what you're telling me is that you've actually found your co-founder first.
Right.
And then you went through like the idea hunt together, right? We're just, I mean, not everybody goes that. Some people start the technology and they want to commercialize it.
Right.
Some people start with the problem, then they look for the team. We started with the team first. What was that search process? Were you just hanging out because you both are from Southeast Asia, want to eat Southeast Asian food? You know, like how does it work that you met your
We do end up spending more time because it's easier to share cab because he was driving, so I could have Asian food more easily over the weekends. But I think it happened almost at the same time. So that I came across the idea. I was doing some research myself, like based on first principles, thinking, McKinsey training, and so on and so forth, to dissect the business model. And at the same time, I met my co-founder, and that one thing I found was that during the various like trips together is that he's, in the second generation reach, there are two categories. The first category is that, hey, I'm set for life. Let's just chill and enjoy life for what life offers, right? He falls on the second category, which is that, hey, I do want to be known to be successful because of my parents. So I know this guy I can work with. So in that two conversations, I realized that, hey, our values align quite a bit. And of course, it's further confirmed after we decided to start a company, right? Whereby we did one thing that, like, starting your business with your classmates is a big no-no in most startup literatures, right? Because you want to find people with complementary skill sets. And being in the same business school, in the same class, that it does not, oftentimes will not mean that, right? But I think one thing that we did which turns out to be very helpful on hindsight, was that we actually did all the arguments quarreling up front, which is quite counterintuitive, because generally when you start working together, you'll be tiptoeing around, you'll be a bit cautious and whatnot, right? But I think because of our values, that we were just trashing things out quite openly, that, hey, what if one day you don't want to be in a company anymore? Hey, what if the company becomes unsuccessful? What if we are back being sued and so on and so forth, and stuff like this, right? In fact, we launched Indonesia 6 months after launching Singapore, and at that point in time, it could be accused as deposit taking, and technically it's a jailable offense, right? So we were just going through all those situations, and who's going to make a decision? How do we think about shareholdings? Not just the usual like 50-50, like what's the right framework and so forth. So I think because we have trashed out all the hard decisions, we flipped tables and whatnot during the early days, such that even after when we came back in 2016, so we started company in 2015 February, after we came back from HBS at 2016 July, August or so, that he was based in Jakarta, I was based in Singapore. We were so aligned such that, because at that point in time, such that even we did not meet as often, we exactly kind of know where each other stand, and we were very in sync. So I think that trashing out phase at the start, which was quite not very commonly done, has worked out very well for us.
Yeah, fantastic. And what's interesting is, okay, so you found your co-founder first, you felt like you had a good match, you had the debates up front, and then you started going through this idea hunt, right? But obviously there's so many ideas that seem like they make sense on paper, right? And at that time, even though you're both Southeast Asian and you're in Boston, you're looking at obviously Asia from far away. How do you do this like product market fit testing to be like, okay, this is actually worth setting aside my private equity, BETNA, opportunity cost versus this.
I think how to determine product market fit as well as this being worth our time. We again did what Harvard asked us not to do, right? Which is that we literally just did it and see whether it sticks.
Just do it, Nike. There you go.
It's like at the start, it was like, hey, what does the SMEs need? Okay, term loans. Okay, it didn't quite fit. Like, how do we manage? Oh, we saw a competitor offering at that time it wasn't very clear what you should call it, and we later on coined it as invoice financing.
No.
Also, and we did really literally just throw everything on the board and see what sticks also, right? Well, of course, we did some secondary research and whatnot, but we realized that when it comes to SMEs, there's very little secondary research. No one cares
exactly.
about them also. So we literally just hired a team of 4 initially and then try to launch it, right? And then, okay, now that we have a team on the ground there was one person who does credit, it's a specialized skill. The other one person does sales because it's critical. There's someone a bit more senior who does marketing at that point in time, trying to get crowdfunding license, regulations like customer service, and then you have an analyst that does everything, right? So it's really a team of 4 or so. We just threw it on one and see what sticks. And for tech, how did we solve it was like no one would work for founders that are not full-time and was not even physically around. So we did what is the only realistic path, right? We got a small IT firm in Indonesia through the connections of Reynold, my co-founder Reynold, and tried to create a website for us, right? Literally, we learned how to wireframe, drop boxes by ourselves, and get into code. And when we were fortunate to raise our seed round during summer holidays, and Series A, like Sequoia gave us the term sheet right before our graduation. And upon closing Series A, we just told the IT firm's founder that, hey, why not you shut down IT firm and join us? Which he did. He basically gave up his shares and let his other co-founder run that business and then join us full time.
Wow.
And that's our first IT tech team also, a CTO also. So I think it was really just did it and see if it works. I think from a worthwhile perspective, we knew that it's a big need. We just may not be fully sure how do we actually solve it at that point in time. But at least in a secondary research that we knew that it's going to be a big need, and that because we were in school at that point in time, clearly the opportunity cost is quite low. Like opportunity cost is really internship in other companies. The amount of parties that we go is a bit less. We are not the best students in class. Like most of my friends at HBS will say, do you remember that case study? I don't remember any case study, but because most people prepare hours before, the days before. Like we literally prepare, the classes are always 2 hours long, or is it 90 minutes long? We always prepare during the first 30 minutes of the class, listening to what others say and try to contribute. and the second half, and that's how we pass our classes. So optimizing to get a realistic path towards achieving in terms of running the company. Yeah.
Yeah, I know. It reminded me of also me building a company. I think you were better than me. I just failed my class. That's why.
that's a brave move.
I just failed it. I was like, oh shit. I don't know what this case is. So you're better than me, smarter than me, and faster than me. So what's interesting is that so you just do it. You raised it. You went for it, and then what was it like? Because you graduate and you fly back to Asia, and at this point you've been running everything remotely. Now you're finally in person. What was that transition like?
It was actually 2 things was funny in the sense that firstly, when we meet the team for the first time, it's like, oh, this is how you actually look at like in full person and whatnot, right? Oh, this is the first time I see the office because the team just send us the bill, and initially it was at the dining table of my first hire, and then subsequently it was a small 3 seats, and then later on was 1 room for the co-working space and whatnot, right? I think, but besides that, the whole working chemistry was very strong because we were there at the start, even though we were there virtually also, right? But that also forms the DNA of the company eventually, right? That we are very comfortable in terms of working as a distributed team as long as you deliver the results also.
Right.
And I think a bigger transition was probably going from professional services to being a founder, running per se. But I think was very fortunate that I had a bit of interim step as part of KKR Capstone, and also within McKinsey, whereby in the case of McKinsey, at a time when everyone likes to do strategy work, I knew that if all the other McKinsey guys can do strategy work, what's my differentiator, right? I have, of course, a year at Essential, so I have a bit of exposure towards IT and whatnot, but that's not going to be enough. So when everyone was just doing strategy or focusing on doing strategy, I spent half of my time doing operations execution. That's where I did a bank transformation so that I can at least one up the other McKinsey folks, and that gives me a slight advantage. Right? And then subsequently, I kick out Capstone, also thinking from a shareholder's perspective. So that, to an extent, gave me a bit of a soft landing towards running the company. And I think in the initial days, we devoured books quite a bit. I will be finishing a book a week or so, because there's so many things that we just don't know, and also, right. And of course, it cannot replace full-fledged personal execution, but I think it gives me some level of pattern recognition of what are the possibilities, and that helps to actually accelerate the growth curve in terms of running a company.
Fantastic. And you're making all these decisions remotely, then in person. But also, I think what's interesting is that you're also building this across Singapore and Indonesia. And I think that's something that I was inspired by you. Obviously watching from far away. But you built 2 countries with you and co-founders, so very high level trust. What was your decision making between both of these two countries? I mean, technically, I'm just saying you could have been Singapore, Vietnam, or
Right.
obviously there's a country link component, but I'm just kind of thinking, what was that thinking that you had?
I
Yeah.
think first at a strategic level and then execution, right? And from a strategic level, our thesis was that SME finance is a high volume, low margin business, such that if you are not covering enough scale, it's very hard for you to be successful.
Right.
And it's so part of the thesis of how do we of creating a path to be number one, right? That we figured that for us to have that kind of skill, you need someone from Indonesia also,
Yeah.
and that's for my conference coming very nicely. And being Malaysian by birth, I think I have some advantage in Malaysia. And
Right.
because the fintech rise came from the US, like most of the peers in Southeast Asia probably will not know.
Yeah.
So if you combine the fact that, hey, SME finance is a very localized business,
Right.
but you need to know the US fintech understanding. And my hypothesis was that most of our competitors will likely be bankers.
Yeah.
Actually likely from the most, right? And they'll only know the Southeast Asia leg, but not the fintech exposure overseas. And number two is that they'll most likely be comfortable in one country because bankers are very siloed
Right.
in terms of how they operate, right? Whereas we at least have a regional footprint also. That was one of the key theses as to how we could create a path to be number one, right?
Yeah.
And so we knew that we had to do it anyway. So then the next question is that, okay, fine, how do we do it in a market that how do we build a team locally also? I think candidly we got lucky initially in terms of new team hires. It could have gone horrendously wrong, right? So we managed to get Iwan Kurniawan, who was a management consultant at Oliver Wyman, and we're connected with him. We go through the same process of trashing out the toughest questions and whatnot. And I think things checked out, and he basically started the Indonesia business for us. We were like remotely managing of Singapore also. And then we repeated the same process for Malaysia, which we started 1 year after Indonesia. So literally February 2015, we started, but not quite incorporated also. And then we launched in June 2015. In Singapore, we launched January 2016 in Indonesia. I mean, it was launched during our summer holidays also. And then Malaysia in February 2017, quite shortly after.
Yeah.
So by being very lucky, it was the first team that we hired. Yep.
Yeah. So let's talk about that. You said that the geographic footprint and regional presence is important. Obviously, for a PowerPoint deck, it always looks nice to flex, on the region. But what does it mean for capital movements? Because we know, for example, Singapore is the financial hub.
Right.
Obviously, Indonesia and Malaysia about SMEs. But do you see any corridors or country differences or flows that are important when you think
I
about
think when
this?
it comes to capital flow, actually, the key advantage was to an extent equity raising, right? Because I think Singapore VCs had a more developed VC market, even though our first check came from Indonesia, came from Alpha JWC, as well as some of the angels from Singapore, right? But I think less on the capital flow slide, but I think more on, we recognize that when it comes to SME finance, SMEs business is a very localized business. What is transferable is only 50-60% or so, right? But the scale access piece is very important. That's number one. But number two also is that we do think that there's a certain level of synergies. At that point in time, we didn't realize it as big. We knew that it's critical, but we didn't know it as big. But I think what has played out 10 years later is that the diversification has helped us to survive COVID-19. When Singapore, Malaysia shut down, Indonesia were the one that numbers supported the entire group numbers, right? And when Indonesia shut down, Singapore, Malaysia, Thailand supported the numbers, right? And whenever you have any domestic sectorial shocks, the other countries can actually support accordingly. So unlikely the entire region, all sectors are being impacted at this point in time.
Yeah.
So that diversification turns out very key. And I think number two also is there are more synergies than we originally expected. So later on that we did see that there's advantage in terms of capital flow, in terms of talent. If you're a Singapore-only company, people may not join you. Indonesia company region, I think that people tend to join also. Similarly, when it comes to regulatory transfer, right? That, hey, when we first launched in Singapore, the Indonesian regulators will reach out to us and say, hey, in terms of engagement for regulations, of course, we're not going to say that you should copy Singapore, there's a suicidal move, but rather, hey, these are some other countries are doing it, and this is what we think could be relevant for Indonesia, what you think also, right? So I think the synergies played out quite tremendously, such that you'll notice in each of the markets now we are the market leader, but even for the other players, it tends to be very, like single country players, a lot of them are very vulnerable towards shocks, especially in the last 5 years where we went through 2 Black Swan events, right, and they did not survive. Also, of course, there are some exceptions, and we can talk about them, but I think it was really the regional thesis that worked out. Maybe one more point that is relevant is that it would work out if the regional play is accompanied by the necessary execution ability, because it could have been just 5 shitty businesses that we have launched as also, right? But I think that maybe it's because of part of our DNA as ex-consultants and being very hands-on and being close to the market that has enabled us to actually ensure that all the 5 countries are executing well and be able to come up from challenges and mistakes.
And you said that, there are some exceptions to the situation. Could you share what those exceptions are?
So we have seen, like when it comes to consumer space, being in a single country can be a very strong business.
Yeah.
We have seen if you have a very good traditional player as joint venture partners, like one joint venture can feed the company. Of course, the question is going to be that outside of the joint venture, to what extent can you actually target the other supply chains, right? And what happens if there's a macro shock in that particular country, which not all countries have experienced that in full scale. So I think to us, so far the playbook has worked out very well for us, but we have seen other models that work out reasonably as well. So it's just different choice that we've taken.
Yeah, I think that's very, honestly, a very nuanced and thoughtful observation of yours. What's interesting is that, we've seen FinTech kind of like go through this, there was this giant hype cycle that was there. And I would say now it's more like a winter, I would say, in the region. And I think what's been interesting is I think we've seen a lot of startups kind of like not manage your books well in terms of, I think lending, is one thing, but collecting the repayment is another thing. And that risk, I don't want to call it management, has been a problem for many of the lending businesses. I'm just kind of curious what your thoughts are about that.
Think maybe just one quick point in appreciation for predecessor that relates to our previous question is that we also did a regional play because we were looking at how Grab versus Gojek playbook, Tokopedia versus Lazada playbook, right? And we think that ultimately regional players will win in the sense that in Canada there are many very ways, right? And like the most brutal way is that, hey, once I win in 5 markets or so, any new 6 market, I have enough profit pool to even price war if I need to. Of course, that's a very aggressive and pessimistic way, but I do think we did study some of the predecessors and very grateful for the lessons that have left behind for us, for both Grab and Lazada and of course Shopee nowadays, right?
Yeah.
So grateful and just want to recognize how we them and we're just standing on the shoulders of giants. So coming in terms of overall credit risk perspective, I think a few things that were critical to us, right? One was that we took a very cautious approach in the sense that when we asked Sequoia in Series A, like, dude, why do you all invest in us? Candidly, there were other players that started earlier than us, supposedly a lot more experience because they are 40-year-old bankers and whatnot, right? And like these 2 kids, 28 years old, why do you all support us and waited for us until graduation? Because one funny story was that Sequoia actually asked us after our sit round. Sequoia reached out to us. They were asking us questions. I didn't know that's called due diligence at that point in time. I was just being obliging that your Sequoia asked me questions, I'll answer, right? So asked me questions, I answered. They asked us for a meeting. We flew back, attended a meeting, and then we went and then flew to Boston again within 72 hours, right? So we didn't know that was quite an icy meeting. So they offered a term sheet and then subsequently put back weeks later. And I was like, dude, you're Sequoia, how can I do something that's such bad form? And it turns out that they didn't know that we were students. Because we're just looking at Asian hours at that point in time. But very honored that they waited for us right before graduation. They gave us a term sheet again. And they've been there for us during various shocks and whatnot, which also some of them related to the credit for the market also. So I think why they invested in us is that they said we were very aggressive when it comes to execution, but very conservative when it comes to risk management as well as regulations, right? So when others were just, hey, let's just grow and show skill so that we can actually raise bigger capital, we took the opposite approach that, hey, we will go steadily to make sure that we have a quality book and whatnot, right? So that was how we've started. So it was in our DNA that we want to be careful and whatnot. It's also partly why there's this funny story that in the first 5 years, we barely have enough default data to train a model enough because there were quite few of them, right? But I think the second thing that also stands out very critical was thinking from a first principle perspective, right? Because I think partly because of McKinsey training, we didn't go by that. This is what the banks do it, therefore we must do it. Of course, we treat what banks do it with a lot of respect and we try to learn how they do it and whatnot. But we basically think from a first principle perspective, right? That at the end of the day, credit is really ability to pay and willingness to pay, right? And it's usually synthesized into 5 C's of credit, which is capital, collateral, character, condition, as well as capacity, right? So, okay, the banks ask for capital, collateral, and of course, character. And if you think about it, it's really because of the business model that ultimately banks make most of the money through interest income when it comes to loans also. And which also means that they have to give a 3 to 5 years loan. But how do you know if an SME will survive 3 to 5 years? By making sure that their big company has this capital. Or they have collateral that the company may not be alive, but the asset will still be alive. They therefore can get back the money. So we know that we can't win this game. So how do we structure it? We're also copying or modeling after some of the other fintech companies in the US and China also. So we actually did study some of our peers quite a bit globally to see what are things that we can learn and stuff. we decided to structure the business in the opposite way, right? That they focus on capital, collateral, and character. We look at character, capacity, and condition. Capacity is really cash flow capacity, right? That how do I know what's your cash flow for the next 6-12 months or so? That's why naturally my loan tenors has to be short, because how the hell will I know what will happen 12 months from now? But I can probably know what will happen 6-9 months from now, right? That you may not be alive next year, but you have enough money to pay me now. So, and then condition, how do I structure the product also? That came in a bit later in terms of ability, because initially, like, we didn't even know what is invoice financing, and we gradually learned it also. Like, but later on, we built a very strong capability in terms of both product structuring as well as cash flow capacity estimation, right? And then subsequently layer on with experts. So we were very fortunate to have a board risk committee that was chaired by Terry C, who was an advisor for us since 2015, to help us to avoid the major mistakes that the Chinese have made. And then once you have a repetitive execution, you start layering on with digitalization technology. And then once we accumulate enough data, we layer on with AI. And then once the company reaches a certain scale, we layer off with not just country credit, but overall regional risk management, like what the banks are doing. So and so forth, right? And we of course try to learn from our mistakes that most of our peers that collapsed in the last few years collapsed because of two reasons, right? Either corporate governance or concentration risk, right? We learned, I think corporate governance, we're quite fortunate that Sequoia actually held us a very high bar since 2016, right? So that was fine. But I think when it comes to concentration risk, we learned our mistakes in 2018 when we were still relatively small or so, right? So that will help us to actually withstand the hit. It also helps us to learn and avoid in the future also. So it's really fortunate that we have the strong support of shareholders, but also rethinking the credit from a first principle perspective that helps us, and combining with what others, the banks and whatnot, they have done well, such that we have actually been able to navigate through the various cycles.
How did you learn about concentration risk in 2018?
We just had a big default.
Yeah.
We just had a big default, and that we were extremely apologetic. But I think thankfully, because we were always fairly contrarian, such that even in the first few years or so, 2015 to 17, we told the investors that, hey, there's no default so far, but default is going to come. Please diversify, please diversify, please diversify. And we even forced investors to diversify, right? That, hey, if you invest, you deposited $5,000 on our platform, and we see you putting $2,000 in one company, we actually block, and we start setting a limit in terms of how much one can invest in a particular loan, right? So that helps us. So some of this contrarian and early thinking has avoided a potential blow up or so. But I think because the default, there was a big default such that you see a sudden spike in terms of NPL, that we learned that, hey, like how the hell do we avoid this? Because the natural human tendency is that, hey, these are bigger companies that are safer. They ask for bigger loans. If you're giving them a small loan, they'll ignore you, right? So you play to it, right? But this strategy works when it works. When it starts collapsing, it can bring down the company, right? So we started thinking that, how are we going to reduce concentration risk also? And we realized that actually, to be fair to other platforms as well, that it's almost impossible for you to avoid concentration risk at the start. The question is whether are you actively reducing it over time also, right? Because based on the macro conditions and based on the fundraise environment at that point in time, if you are not growing reasonably fast enough, you're not going to attract your capital, and that's just fact of life. And of course, it can be irrational at that point in time, but that's fact of life at that point, right? And if you are doing too many small loans or so, your product unit economics will be terrible, because you will not be automated enough early, right? And similarly, the risk on the smaller companies will be bigger also. So you are really choosing on outsized high risk segment versus concentration risk, right? So both are tough choices, but I think that the key is that, hey, you need to take certain level of concentration risk, but make sure that you actively reduce it over point in time. And that's how we have actually survived through the various sectoral recessions. Example, there was a whole construction recession in Singapore, and then there was this whole trading companies exploding. And then subsequently you have COVID, and of course the multi-decade high rate hikes has actually damaged the SME fabric quite significantly after following quite closely from COVID-19, right? But we managed to navigate the various credit risk still because of the lessons learned over time.
Yeah. And what's interesting is that defaults aren't easy, obviously. And obviously non-performing loans on a platform is a fact of life for any lending business. So it's about how you manage it. I think one interesting part is that in Southeast Asia, there's also a lot of like due diligence risk, right? So, you're a CPA. So you know about this, you've done due diligence as well. I think in Southeast Asia, there's a lot of like, you can call it fraud, you can call it waste, negligence, leakages of capital, So, and that makes it obviously difficult, right? Whether it's a small company, a medium-sized company. I mean, the joke always people have is like, there's 2 or 3 books in Vietnam, for example, right? So how do people think about that process from a lending perspective? How do you manage that?
I think first and foremost, this whole phenomenon does cause pain to the better players, right? Because now investors or capital markets tend to paint Southeast Asia in a similar brush, and you have to prove yourself so much more than, in my view, it is fair per se. But I think this is it's just evolution of the industry, and over time, with more good players emerging and proving that, hey, our corporate governance are tight, I think that the capital markets investors will change their mind and have an updated view of the region. But when it comes to on the credit space perspective, I think we again did something that's quite contrarian compared to what other players were doing, right? At that point in time, everyone was saying that fintech, as if you don't need a lot of information and can give you a credit score supernaturally, right? Using social media, and footprint and so forth, which is accurate to a certain extent when it relates to consumer lending. But because SME lending, the reality is that the risk factor is so heterogeneous such that it's not just the business owner themselves, and even less so being reflected on the social media on what we say, right? So they are helpful by that. They are not as statistically significant as some make up to be, right? So that's why we did a contrarian view approach of we actually asked for a lot of information documents from the SMEs. So when others were saying that, oh, you don't need to give this and give that, and they're really just being more like they say that you're using technology, but they're really just taking more risk per se, right? We actually asked quite a significant amount of information, actually more than what the banks are doing. And I think we could do that because what we're really replacing is money lenders. And in the same case of Singapore, money lenders charge up to 48% a year. Or like credit cards, 24% or so, right? So, or friends and families, right? So we're really not competing with banks, we're really competing with all these high risk lenders. And because the next best alternative is actually quite bad, such that the SMEs are actually willing to give us this information. And because this information for a decently run SME, you should have them. So if they can't give us a rate flag by itself, right? And with that, I triangulate the various information, right? That the financial statements, links to bank statements, links to tax filing, links to AR, AP aging, like all these are related, right? And that after a while, like how can this number be so good when that number is so bad? Also, like and it's very hard for you to doctor all these sets of information at the same time. So that's why, from a fraud risk perspective, like there are still fraud risks, but it's actually relatively low compared to what others have thought, right? A lot of it is counterparty risk. The SMEs, they have concentration risk, and if their customers don't pay them, how do they manage also? How much buffer do they have, so on and so forth? That has resulted in defaults for SMEs.
Yeah, I think counterparty risk is also, it's related to what you said, sectoral, right?
Correct.
Just like, the big mothership construction company,
right?
And the subcontractors all ripple down when there's a default or some difficulty, for example, right? So I think counterparty risk also is a big part that's, I imagine, quite difficult to size. Is there a way for you to size counterparty risk?
Ultimately, we try to manage it by of course, reviewing the AR, AP aging quite closely and seeing whether what they submitted to us is even believable. I think first and foremost is that if you see usually a bank underwriter, where you give them information, the first thing is to put into a spreadsheet and whatnot and compare ratios and stuff, right? For us, the first thing is to see what numbers I can trust, what numbers I need to discount also, right? I think when it comes to counterparty risk also, we evaluate AR, AP aging, but equally important is what is the cyclicality as well as the sensitivity of the numbers. That, hey, your numbers look very good in the next 6 months, but based on the cyclicality of this industry, in 3 months' time, you're going to see a down. So can I actually trust this number to be representative of the future? No. So I need to adjust accordingly, right? Number 2 is also what's the sensitivity of variability of the various costs and revenue, right? Assuming that the worst case sensitivity hits, like how much cash flow can you actually support for repayment? And then finally, what are the alternative source of repayment that can pay us, right? Not just based on the business or so, right? So I think it's a lot of better scars as well as accumulation of 10 years worth of data that has enabled us to navigate. That's why to an extent, we see us, I think the original thesis that, hey, we'll be able to hold our ground despite big tech companies coming in, I think has gradually proven just because of SMEs, the key success factor is not just distribution or technology, right? A lot of it is just historical data. And this historical data, especially for loan repayment data, is extremely hard and expensive to get relative to what a big tech company is giving, right? Just a basic example, that for consumer lending, let's say you can give a $1,000 USD loan, is quite a decent amount, decent size, right? And if you want to build a decent model, 10,000 unique borrowers, it's just $10 million is doable. If as an R&D cost, right, you just burn it and you get enough data also. But if you imagine for SME lending, $10,000 is not a very big number in the first place. And if you want 10,000 unique borrowers, that's $100 million per market, right? That's a higher barrier to entry. So I think it's really, given that we don't have such money to burn, it's really accumulating over 10 years to build a model that has given us a good advantage, and then further layer on with diversification technology, and of course now GenAI, and finally capital sources that have helped us to build a pretty sizable advantage in terms of managing credit risk.
Yeah. And my last set of questions is that what's interesting is that you started out the lending piece and now you're doing payments as well. Could you share a little bit more about why you decided to enter payments as a space?
Yeah. I think for us, it's really to think about, okay, next step, what in terms of competitive mode, right? And we wanted to address two issues within SME lending, right? Which is customer acquisition costs. And number two is, of course, data, right? Because, also, so I think we have explored, hey, e-commerce enabler, SaaS, and so forth, and whatnot. We eventually set up our payments because we find that that is probably going to meet our needs the most, right? That when it comes to, let's say, a customer acquisition or so, for every 10 customers that I meet, I can, and give me a document, I approve 2, meaning that I waste 8 of them or so, and that I need to reacquire them as customers, right? What if I can actually acquire them and keep them for longer? So payments, like most of people, payments companies can clear KYC, and that's and some level of credit risk underwriting. So I don't waste them also. So it's a bit similar to the Square Block playbook, right? That add multiple product lines such that I always have something for you, so I don't have to reacquire the customers, right? The second one is really on the payments data, right? So that it can actually complement our underwriting. And we realized that unless we're going by ourselves, it's very hard for us to get from third party. And even if we get from third party, that data source is not going to be very stable for us. So we decided to do it by ourselves. And I think we were very fortunate to have made CardUp through the Square network. Is a Sequoia Series A company that we find that is a pretty good fit also. And we realized that, hey, payments DNA and lending DNA is so very different. If I'm going to learn it by myself, it could take 10,000 years, right? So I thought, okay, acquisition is the most natural path. And we've learned a ton in the last 3 years because we formally acquired it in December 2022, right? That we managed to 6 times the GTV in 3 years, despite not knowing that much about payments at that point in time and having a very good post-merger integration program, keeping the core talent and of course upgrading the talent along the way as well, even though it was the first time for us to do it. And again, it's based on first principle that, hey, what makes sense? And one of the major lessons is that I think most people's natural human tendency is let's integrate the teams and structures and whatnot, right? And when I think about it, right, that you should not, like, org structure is the last thing you should be integrating. What you should be integrating is mindset, thinking, culture, values, all the things that are below the surface, right? So that people are thinking in the same way, you know the folks and whatnot, so that you know what is the new org to draw, right? Because before knowing and building trust and relationship and aligning values beforehand, and then you just recklessly or integrate, merge the org structure is a recipe for losing good people, and chances are you'll be drawing an org chart based on some random arbitrary ideas or so, or so-called best practice that doesn't fit Southeast Asia, right? So I think we're very fortunate that the core group stayed with us and integrate with Funding Society's team very well, and now it's become an integral part of our business.
Fantastic. And could you share a personal story about a time that you have been brave?
I think there have been many episodes, right, that right after our graduation, MES came out with the regulations that we need to be licensed also, and the wording of regulations wasn't as clear. So a lot of industry players decided that, hey, it means that we can still run, and while we apply a license, right, we took the choice of clarifying MES, and MES said that, hey, you need to pause. Sequoia gave us a term sheet, but they have not closed around because they were doing their financial and legal due diligence. And we had to tell them that, hey, 90% of our business are not legal now, and we had 2 months of runway and a bank account, and we just graduated, right? And so basically we'll be on track to be the first group of 100 students to lose their job upon graduation. And at that time I was getting married, so like it was an interesting time to tell my parents-in-law that, hey, your son-in-law is gonna be out of job very soon or so. So I think what we did was that we actually complied. We used the 2 months runway to hire good lawyers to apply for a license to guide us, and really to change the whole business model from crowd peer-to-business lending to on-balance sheet lending, and convince the only institutional lender who gave us a bit of money on a platform to actually go onto balance sheet. And was very fortunate that despite not knowing when we'll get a license, because the first time that ever there's that license, we submitted our application. The numbers did not drop that month. We actually converted into balance sheet lending quickly, and we continued to grow. We confessed to Sequoia and said that this is what's happening, this is what we're going to do about it, and this is what we're thinking moving forward. And we'll try to grow the Indonesia business, which was just 10% at that point in time. I was very, very grateful that Sequoia legal head was really supportive of us, which is quite counterintuitive. Also really appreciative. So very brave moment for him as well. And Sequoia's honored the deal and continued investing in us. And then fast forward, you have the whole COVID-19 time when the writing was on a wall that our revenue growth is expected to be like this, and cost structure was structured like that. But we know that revenue will be much less, right? So with that cost structure, that's not going to be sustainable, right? So at that point, we were among the first to conduct a layoff, which was quite unheard of in the industry, right? Because to us, is that the writing was on the wall that this has to happen. And if we are to take care of our team, we should do it early so that they can find jobs before every other companies did, right? And that it was a very painful moment because despite, in our view, doing the right thing, and turns out that all the team members did get great jobs from Grab and Amazon and Facebook and blah, blah, and so forth, but we were destroyed in social media, in news and whatnot, as if we were the only company that screwed up. That's why we were being laid off or so, right? But later on, when it became a common practice or so, no one would speak in gratitude that, hey, thankfully that we did a layoff early such that everyone get very good jobs also, right? But I think that it's also a lesson for us that for us, the focus is really making sure that we're doing the right thing based on values, based on facts, not necessarily based on popularity, right? Because I think that it's just nature of what leadership should be. And we've also gone through moments whereby expanding to new countries, some of them are very volatile, and the board may not actually be agreeable with it. Because I think going regional is quite a contrarian view from a US conventional wisdom perspective, right? Who do one thing and be 10 times better. But in our view, if in Southeast Asia is such a fragmented and heterogeneous market, if you do one thing with 10 times better, with a really good and really tiny company that no one cares about or be relevant, right? So we actually went against the board in some decisions, but thankfully the board stuck with us, and thankfully our decision worked out also. We also taught us a very important lesson, right? That whenever you upgrade an organization, upgrade your HR first, because you need them to be ahead of the evolution of the company so that you can get the company to be ready for it.
On that note, thank you so much for sharing all of the summarize the 3 big takeaways. First of all, thanks so much for sharing about your initial founding story. I thought it was really fascinating because if you ask me, I thought that you started with the idea first and then the founder, etc. But I thought it was just very good to hear actually about how you then found a co-founder in parallel with the idea, shortlisting, the ideation, and also all of the initial thinking about your career and taking on that bet of building a company. Second, thanks so much for sharing about your product market fit evolution of the company. I thought it was very interesting to hear about at the start, it was just do it. But then, you sound very intuitive there, but then actually you also show that, you're very thoughtful about, multi-geography, diversification, concentration risk, and also even expanding the payments, right? So I thought it's interesting to see all of that thinking from a strategic perspective, which is, I think, honestly a masterclass for anybody who wants to build a fintech or lending company. And lastly, thanks so much for sharing about, I would say, like the industry. I think there was a lot of clues that you gave about the macro trends, whether it's about fintech, whether it's about, the common principles that people have regarding their risk models versus risk management, versus diversification, versus concentration risk, versus counterparty risk. And I think that's really important because I think once we can unpack all those first principles, then I think we can say, okay, these are the things that Southeast Asia is good at. These are the approaches that will be good for what Southeast Asia is good at. And these are things that may not translate easily one-to-one. And I think you gave a few examples of US companies that would not translate one-to-one well to Southeast Asia.
Yeah.
So on that note, thank you so much for sharing your experience.
Thanks for synthesizing perfectly. I really appreciate you having me here.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.